There's so much pain in my body, it's like that old town road, yeah. And I don't think they can stop me, cause to the top, yeah, that's where I go, yeah.
How y'all doing today, man? It's your boy Quay Adventure. Back with a YouTube video, man. This might be the first video, second, third. I don't know. I'm just making them right now, man. And I'll drop them when I drop them, man. Once y'all see them, y'all gonna be like, man, this the last video or the first video, but this might be the second one, third one. Who knows, right? It don't matter. Point of this video is how the banks really trade, man. Because there's a lot of people on the internet saying the banks do this, that, the other, man. I'm gonna break down everything hand in hand, come back with y'all, man. So y'all will have a better understanding of how the banks, they really get down, man. So let's without further ado, let's get to it, man. Got talking to the mic. I mean, it's hard to talk to y'all and look into the mic. So we're just gonna rock with it. It don't matter. Share screen, man, because y'all gonna look at the chart anyway. But let's get to it. But so I'm gonna break this down by the phases, right? So as we all know, the market moves by creating liquidity and taking liquidity. Deeper into that is accumulation, distribution cycles, markup, the whole Wyckoff cycle. I'm not here to break that down to y'all. I feel like if you took my course, you should already know that. But this is just to understand 4 steps you could take to understand whether or not a trade is good. And basically, these are the 4 phases of the banks. This is how the banks really trade. I'm not here to tell y'all what's a pip. I'm not here to tell y'all how to buy or sell. I'm being honest with you. I'm here to teach you how the banks really trade. So without further ado, let's get to it. All right. First thing that's always happening is you in a trend, doesn't matter. But first thing that happens is liquidity is getting created. So just change the color right here. But I'm cool with that. Just say this all of range of liquidity, man. So let's say this is price, right? Matter of fact, let's delete all this. Let's just focus on the 4 phases right now. We ain't even talking about if we in a trend, none of that. We just talking about where we at right now. All right. So you have a range that's created, right? A range is created. No matter where price came from. We ain't going to the specific. Obviously, ranges ain't gonna look exactly like this. I ain't the best artist, but that's just what we're gonna say won't happen. So what y'all think is on the top side? What y'all think on the top side and the bottom side of this range? It's liquidity. So first phase of the banks. This is the first phase. Write this down. The first phase is creating liquidity. They create a range to make people put stop losses on this side and this side. Oh, double bottom. Oh, double top. Oh, I gotta ride that out. All right, cool. So that's phase 1. They creating liquidity. They inducing all the retail guys in to go and see what it's about. So second phase. Phase 2. Take liquidity. So everybody who has stop losses under here, they gone. Phase 3. They when they took the liquidity, they filled all they buy orders by taking out sell stops. Price shoots up. But when they do this, they still had open sale orders when they sell the market down under this range. When they sell the market under this range, they took out liquidity, but when they push price back up, they didn't have time to close out every single last one of their buy positions. And the banks are not in the game of losing money, losing equity. So what do? Slowly take price back down to this area. Might make some more liquidity, induce some more y'all in. And basically they come back to this area down here to mitigate their risk. Boom, take liquidity from under here. Then they push price above this next range. So let's break that down for y'all. First phase, creating liquidity. Second phase, take liquidity. Third phase, the markup. Basically, price pushes up into the desired direction. So they take liquidity using sell orders. I mean, you can look at this on vice versa. If I could just flip this around, it'll be the same thing. But then they push price above that range, showing that they want to go to the buy side. But when they took liquidity from the sell side, they ended up leaving some sell orders in drawdown. So they probably running billions of dollars in drawdown going up here. Come take price back down to mitigate their risk, then push price back up. So phase one, create liquidity. Phase two, take liquidity. Phase three, markup. And phase four, mitigation. Yeah, phase one, creating a range. Phase two is taking out the liquidity. Phase three, mitigation. And phase four is continuation. So, excuse me, phase one, creating liquidity. Phase two is taking out liquidity. So they took liquidity out on both sides. But as you can see, where they really took out, where it wasn't just no fake out, where basically they took it and rose up, you could tell where they want to come and mitigate from. So phase three is mitigation. Phase four is continuation. All right. Write it down. Phase one, creating a range. Phase two, taking liquidity. Phase three, mitigation. This whole thing is phase three. And then phase four, continuation. So I'm kind of just walk through everything a little bit more specifically before I go and break down the actual trade I took, understanding how the banks trade, right? So identifying what the composite man or the central banks are doing or what they are trying to accomplish is the key to understanding this, right? Because the masses will tell you, hey, just put your stop loss 3 to 5 pips below here. Created a double bottom. Put your stop loss 3 to 5 pips above here. Created a double top. You put your stop loss down there, you're gonna get stopped out every time. Why? Because though that support and resistance you've been trading, that ain't nothing but liquidity. You know how many people trade support and resistance? That's the most known strategy to man. The composite man, he not going to move a $4 trillion market to get Billy Bob, right? I'm gonna explain who Billy Bob is. Billy Bob would be me, right? And you probably like, what you mean, you Billy Bob? I'll explain, right? So if I was just a person that just traded basically off of just stop outs alone, not even understanding the full four phases of the bank, just understanding where people money was at, I will enter right here. That's me, little Billy Bob. The composite man, the central banks, they're not going to move a $4 trillion market to come back and take me out when they have literally so much money they just took from everybody else. So this range here to here, it shouldn't be invalidated unless your trade has actually been a part of the liquidity. So the only way this trade come in and take you out is if you fail to realize what the banks were really trying to do. Maybe you were confused on the right direction. I don't know. But if your stop loss is what 90% of the other traders' stop loss is, then of course the central bank is going to liquidate you just like everybody else. And obviously it's not going to be this obvious, but this is just the first understanding. You have to understand where the liquidity is being created at and try to not be a part of that liquidity creation because it's soon going to get took. And you will hate to be stopped out by half a pip, then the market go in the same direction you was looking at. Like imagine you had your stop loss under here and then it come down, stop you out and continue up. So first thing you got to understand is the central banks only going to make moves that's financially advantageous to him. He will lose more money trying to get Billy Bob, who happen to be in line with his motives, than continuing with the move that has him liquid $500 billion in profit. The Compass man is not going to do that. He's not going to come back down here, take you out because you entered down here by some dumb luck, and then he like, oh, let me take you out because then that's going to put him in even more drawdown. He's already used a lot of his equity just to make this move right here. The reason why you had to be able to identify the ranges you're working with is because the central banks, they're not going to allow the Compass man to have unlimited equity. They are limited by weekly net change allowances. And understanding those limitations give you an edge. So what do I mean by daily, weekly net change allowance? The central banks just can't do this, right? Oh, somebody stop loss right here. Oh, stop loss right here. Oh, let me go back down. Stop loss down under here. Okay, back into the stop loss. Stop loss. Stop loss. They can't do that. They don't have enough equity to do that. They'll put them in more risk of money than actually help them at all. So if you understand that they don't have unlimited equity and they only can move the market a certain way, which is creating liquidity and taking it, you'll have an edge. Because their main objective is to create liquidity, to take it, to fulfill whatever objective they have. But once they take liquidity, they leave positions open, running in drawdown, like I said here. Matter of fact, let me delete this right quick. So as this move happens, right, they sell the market down, but then they immediately do what? Buy it back up. So when they immediately buy it back up, the way they trade, they use your stop losses and pending orders to fill their own positions. They can't just they don't trade like us. They can't just sell the market, press a whole bunch of billions of lots of sales, close them all out, and press billions of lots of buy. No. Basically, like I said in another video, trading is a give and take. When somebody buying, somebody selling. The reason why they create liquidity to take it, because if they get enough people of mass hysteria to go ahead and buy or sell in a certain position, induce you in, then they can use your buys or sales to fulfill their own orders and then take it up. But a lot of times when they do that, the reason why you see imbalances and gaps and all that is because it was more sales than buys or vice versa. When they do this, they leave their positions in drawdown. But let's kind of go over what's first, right? The Compass and man, they form zones to induce traders so they can hit their stops. The Compass and man, he's going to show the retail trader something to make them bite on it, inducing them in. He show you this range, support and resistance, getting respected the hell out of. And you like, man, it didn't respect this zone 3 times. I gotta take this trade, bro. And what happens as soon as you take a trade? Well, if you took a buy down here at this one, you got stopped out right here, waiting on the breakout. If you were smart, you close when it hit the top of this range. But if you enter right here, oh, you really shit out of luck. Soon as you entered, stopped you out. And if you try to take a sale up here, it didn't give you no chance. It stopped you out as well. So, like I said, after that, he takes price down to take the stops, then take it the other way in the desired direction. This is what created what everybody knows it as a demand zone or an order block or whatever you want to call it. This right here, this box I highlighted for y'all. God, Lee, man, my drawing is goddamn like Winnie the Pooh booty. Cut that out. But that whole thing where he sold and bought, that's an order block or demand zone. Y'all got to understand it. So if you don't know what an order block is and a demand zone, it's probably going to be another video up on my YouTube explaining the difference and what is an order block and what is a demand zone and the difference between the two, whatever the case is. I might make a video on that as well. But they clear everybody's stops and aggressively, they clear everybody's stops under here, clear everybody under that support, and aggressively take price away. They aggressively take price away from there to stop people out because they have a plug-in list where they can see who's in margin trouble. So once they say, for instance, if it was some people, right, who didn't put a stop loss here, they tried to sell the breakout, right? They're like, okay, it just broke. I'm selling. Well, price went up here. And if you risk a lot putting your stop loss maybe just above here, but if you put your stop loss right above here, you immediately probably was in so much drawdown, your account might have got blown. You literally would have been in margin trouble. And the composite man, he sees who's in margin trouble. He has a plug-in that literally shows you who's in margin trouble. So if they see $100 million in margin trouble, the market makers are going to take that and run with it. You can call them the market makers, the composite man, whatever the case is, the central banks. It doesn't matter. It's all different terms, and it's all based on the same umbrella terminology of smart money concepts. But anyway, when he see $100 million of people, $100 million, boom, people in there got all types of stop loss and pending orders down there, he's gonna take that and run with it. So they don't have unlimited equity though, right? Like I said before, they don't have unlimited equity. So what are they gonna do? Well, they're gonna bring price back down to this area so they can close some of that drawdown money in either a small minuscule loss or break even. And they're gonna save a lot of equity. What they're gonna do after that? Push price way back away. So all the people who entered down here, or whatever the case is that was holding the trades, they might have been waiting for it to come back down to this low right here. I'm gonna tell you what be happening. People probably was waiting for price to come back down to this low right here, right? Like go ahead and put them back at break even. At least. But what did price do? Came down, mitigated about halfway through, and left. Said, y'all ain't getting none out of us. So the support and resistance zones are made visible by the composite man as a hoax to induce traders to either buy or sell at those zones. All right. And they take the liquidity from those zones. And after they mitigate their losses, save some equity, they leave all the retail traders behind and take price wherever they're trying to take it to. Create liquidity. People stacking up on buys and sales, sales and buys, just entering because this is a very good range to be trading. All of a sudden, that range is taken out from the bottom side. Like I said, this goes both ways, but I'm just explaining from a buy position, but the same applies from a sell position. I mean, you got your range being created. They take liquidity from the top of this range, sell it down, come back, make some more liquidity to induce more people in to have even more reason to come and tap back into this order block or demand zone that was created, taps into it, and leaves people behind. So y'all can take a picture of that, do whatever y'all want to do with it. Anyway, basically this is the 4 phases of the banks, man. And this is just a basic format. I mean, I might do videos on accumulation distribution, but all that's in my course, man. It's just like I don't feel like going over stuff I've already been over. And if you ain't got the course, it's just like some stuff is just gonna be. But I would suggest anybody who don't have money to go get the course, look up the Wyckoff strategy. Because what happens in this range is very important. And what you need to know is this right here will be considered a spring, and this right here will be considered a test. That's a little hint for y'all, you know. Selling climax, automatic rally, secondary test in phase B, spring, tested at spring, high prices. I mean, I've been doing Wyckoff so long that it's kind of pretty easy for me to explain it from that term, but breaking down each thing, I'm not about to do that, man. Get the course. But let's just go to the charts, man. Let's go to the charts, man. Break down the trade I took, kind of based on bank trade. It's all 1 minute time frame. So what did I see, right? Price making obvious break of structure. So this is the first change of character. After this range right here, now taking it out. High, low, high, high. So before we even break down any more of this, let's go to where the trade was taking it. All right. So off the rip, you should be able to tell that this was liquidity being created. People probably was trading it as a little trend line or whatever. And once it got snatched, you should have already knew that basically this market was about to go up. And once it made a higher low, then another high, liquid like resistances was getting disrespected. Basically, that's where price was pushing towards the top side. That's where it really wanted to liquidate them highs out. You should have known then that market might have been about to shift bullish. Because I just look at what's right in front of me. Like, what's the range that I'm in now, right? So, like what I always do, mark up my structure story. And my first TP always is at the top of this range, man. So right here would have been my first TP. Anything else would have been just running profits or break even. So let's go to the 5 second and see what I seen, man. So off the rip, what did I explain to y'all in them 4 cycles, man? A range is gonna be created. And look at this. Oh, I'm not talking to the mic. It's clear as day, man. A range was being created. And not only that, but a trend channel was being created as well. The trend channel, we can kind of ignore that. This is all on the 5 second, by the way. Y'all know I love them lower time frames. But this whole range was being created, right? So let's just see what happens next, right? So price takes out liquidity from the bottom of that range, right? Comes back and taps into that area after it takes liquidity. And what happened after that? Well, high prices. So this don't look exactly like the phases I drew because it didn't break the top of the range. But that's why I say it's key to understanding Wyckoff because anybody could have seen this and tell that this was a spring, all the imbalance left in here, and the fact that this was hold on, let me get this tool. You can look at this as a lower high, lower low. I mean, what the lower low, lower high, lower low. Then price broke above it after just taking liquidity from a range, and then came back to test in that area, and price shot up. So I didn't go down to the 1 second, so I don't know what the hell happened on here. But even on the 5 seconds, you could tell that just by understanding what I told y'all, this was liquidity being created. Liquidity got taken from sellers, well, people who had sell stops in and people who had stop losses in for buys. The central banks converted them into their own buys, pushed price up, made people think, maybe even more people load up on sell positions that had stop losses above here when it came back close to this range and started selling down hard. And all it was doing was coming back to mitigate this order block that was created. Then price shot up. Overall, I got a shout out to my boy Mint FX. You know, I always give flowers what they do, man. But either way it go, this was all caught just by understanding one important thing. This was already a demand zone down here, demand order block, whatever you want to call it. It created liquidity right above that area, took the liquidity, tapped into this 1 minute order block, made the spring from this 1 minute order block, came back. Let me go close up, y'all. Created liquidity right above this order block, this whole 1 minute order block. Made it look like it was going to go into a downtrend, basically taking liquidity under here. Anybody who had stop loss under this range got took out the game. Price came back up, made the spring, extreme buying pressure, took out a minor resistance. Yeah, this was a minor resistance, guys. You could look at this as a lower time frame swing point. Came back and tested into that area right in here, and price shot up, man. Never came back to break even. Yeah, I'm gonna break even right there, and this trade ran a 1 to 20. This is on US 32, as y'all can see right there. But yeah, man, it's really simple. Like I said, understanding, first thing you have to understand is what trend are you in and what would the market maker or the composite man or the central banks most likely want to accomplish. And obviously, just based on the bounds of probabilities, since we was looking at more of uptrend structure, if you take my course, you would know what a change of character is and a break of structure. I mean, change of character, break of structure, break of structure. I mean, that show once you see more than two breaks, you most likely got a different trend about to play out in hand. Maybe not a long-term trend, but a trend you definitely can make some money off of. But after we knew what zone we was looking for, which is right here, even my first take profit, that was a 1 to 8. So even if you would have closed the full trade out right here, that was a 1 to 8. You could have passed my Forex funds challenge, which is just one trade, off only the 1 minute time frame and below. That's why I say it's key to get this second time frame if you were scalping, man. If you don't scalp, you can do this on the 1 hour and the 1 minute, 4 hour, 5 minute, daily, 15 minute. I mean, it really don't matter, man. But I like that 1 minute, 1 second, 5 second, 10 second. I like that fast paced action. I like it real fast. Just like I love my women. Whoa, cut it out. Don't cut it out of there. Anyways, man, like I said, as long as you understand them 4 phases, man, I'll write them down for the people who I'll write them down right quick. Phase 1, create liquidity. So we seen phase 1 right in here. phase 2, take liquidity. And you will understand more of this if you like. I might explain this on a further YouTube video, but if you took my course, you will understand like the steps before you even look for the 4 phase of the banks. Because the 4 phase of the banks is what you really look for when you're looking for your confirmation entry. Or if you really took my course, you would just look for Wyckoff. Because the 4 phase in the banks and Wyckoff, they coincide. But I know if you're watching this damn video, you probably ain't got the money to get that damn course. So we're gonna keep it a buck and a bean in this bitch. Phase 3. Oh yeah, mitigate risk. So we just gonna say mitigation. Yeah, guys. Down here, let's go back and zoom in. What did they do? They took liquidity from this top right here and came back and mitigated that area. Like I said, if you understand Wyckoff, you know god darn well it's not gonna look just like my picture I drew for y'all, okay? So don't be thinking, dude, it didn't break the other high of the range. How would you know to take that trade? I don't need y'all in the comments spamming it, all right? If you know about Wyckoff, you know that them ranges that's getting created do not always look the same. Because if they did, it would be too easy for people to get to trade. The Compass Man is a very smart man. All right, anyways, let's bag this bad boy back. Phase 3 was mitigation. And phase 4 is what? Say it with me, y'all. Continuation. And we're gonna continue this thing up out of there, man. Continuation. So y'all can't say I ain't write them down or you were talking too fast. You ain't no good teacher. Shut up, nigga. Phase 4. Continuation. So what did happen? Even on the lower time, even on just this alone, you could tell that they was creating liquidity to come back to this area, mitigate that, and push price up. So phase 1, create liquidity. That's what they did right above this 1 minute order block. Phase 2, take liquidity. As they did, they took it from the people who had sell stops and people who was buying, converted to the banks buys to buy it above this high, took liquidity right here and left imbalance. So buyers had took over in this area. Well, not buyers, but it was an inefficient price move, and that's another confirmation. Get the course, you understand what it is. Mitigation, right? Price came back and tapped into there. Probably made even more, a little more consolidation right here, which I mean, I'm not trying to try to break that down. That's even more confirmation. But price came back into here, mitigated their risk, and pushed price back up. Didn't give anybody a chance that entered down in here to ever close out any sales they had. Sorry, buddy. If you sold, you lost. But yeah, a lot of things going on in the background. My brother's on the phone. Shit, probably gonna cut this out, but I just want to let y'all know that nigga's annoying as fuck. Okay. And let's stop the recording. And yeah, so hopefully y'all learned something from this video. I mean, I just need some feedback to know how further do videos, but yeah, man. Giving y'all some game, man. It's giving y'all some game.